and Toby Anderson is a financial advisor for Arista. And Arista works hand in hand with Lincoln Financial. They're the folks that provide our 403B and our 457. All right, Toby, take it away.
Take it away. Well, thank you. Let me go ahead and make sure I'm doing this right and share my screen. Hopefully that's everyone. Someone nod if they can see my first slide. All right. Well, thank you, Janet. And yes, so just a brief introduction. So my name is Toby Anderson. I work with Arista Consulting Group. We help advise and oversee kind of the whole Bentonville 403B retirement plan. We work closely with Janet and her team just to make sure y'all are getting the best stuff out there, the best pricing, the best investment options, and all of that. So some of y'all have probably met with a representative from Lincoln. I would encourage you to continue to do that. They're great at helping you. If you get motivated after this and want to increase your contribution, that they're great at doing that, or reallocate if you realize maybe you're not invested the way you should be. But I'm here just as a financial advisor to kind of go through this little presentation. And the one thing I want y'all to take away is if you have any questions related to your investments, your personal situation, whether that's you individually, you and your spouse, don't hesitate to reach out. Janet's going to send out a couple of pieces of information following this. It'll have all my contact information, including a direct link to my calendar. If you want to schedule a 15-minute call, a 30-minute virtual meeting, whatever you want, we're here just to be a resource to help answer your questions, make sure you're on track. Some people have folks they work with and can ask those questions. We have found the vast majority of people do not. And so we're trying to kind of bridge that gap and make sure that, you've got all the resources you need to be on track. So with that, we're going to talk a little bit today about investments and strategy. We're going to talk about it directly related to your Lincoln plan, but the stuff that we're going to talk about applies as a whole. So, this is a great time to kind of talk about the market and bear markets, because the last 12 months have been certainly extremely interesting, not just from a work and family and everything aspect with the pandemic. I did get my second vaccine shot, by the way, today. So if I drop dead in the middle of this, you'll know why. But if you think back where we were a year ago, it's when things completely got turned upside down, right? Lockdown started, all the teachers and school systems around the country had to start figuring out what is life going to look like? How do we teach in this environment? And with all of that uncertainty, the stock market went crazy, right? The stock market hates uncertainty. There's a lot of things it can figure out and work through, but when it doesn't know what's going to happen, that usually is a bad situation to be in. And last March was certainly one of those situations. You can see some of the numbers here from some of the previous bear markets, but a lot of those lasted for several years, right? We had a 34% drop in the stock market in 1 month last year. That had never happened before, and obviously prompted a lot of questions. People didn't know what to do. Should I make changes? Our phones were ringing, as you can imagine. Do I go to cash? Because you look at some of the numbers there since World War II in 1946, there's been 12 bear markets, which is a 20% loss or greater in the stock market. Those usually happen over an extended period of time. The recession of 2008, it took 14 months for it to drop 30%. It happened in 4 weeks this past time. But the thing that I want to help people understand here is it's not a time to panic, right? Yes, maybe you should make some adjustments, and yes, maybe those are some times when it's a good opportunity to ask some questions, revisit what you're doing, make sure that a lot of folks hadn't seen big drops in a long time in their portfolios or in their retirement accounts. We had 10 years of where pretty much every year it just went up. If anyone's on this call and has been teaching or working less than 10 years, what happened last year was a first for you. A lot of people didn't even realize your investments can go down. All you would do is ever seen them go up, and it caused a lot of anxiety for a lot of people. but keeping it in perspective, there's been a whole lot more bull markets, which is periods of times when the market's going up. And you can just see, this just shows the averages of the S&P 500, which is just a good benchmark, that financial people use it's 500 of the largest companies around. You can see how few times it actually posts negative numbers. So most of the time you're seeing, 6, 8, 10, or even more rates of return, and especially if you look at that over long periods of time, right? There's 99% of the time over 5 years, it's always positive. 100% of the time over 10 years, you've always made money, right? So, what happens in the world we live in is because of the barrage of news and social media and all that other stuff, and the fact that money is such an emotional topic, right? I mean, it's important to us. It matters. And we can tend to make decisions based on emotions, not based on, thinking long-term, making rash decisions. And this chart shows it a lot because, I had a chart the other day that talked about, the average investment, the average mutual fund has earned if it has earned about 8% over 20 years, that's great. 8% per year, everything's great. But the average investor is only earning like 2 in that same fund because they're making changes. They're panicking when things get bad and they're selling. They're going to cash for a little while. Then all of a sudden, oh, we've had 3 or 4 months of great numbers. Now I'm going to go back in. Well, you just missed, those 3 or 4 months are very key. And this chart kind of emphasizes that, it doesn't take missing a whole lot of time in the market to really significantly mess up your return. The top line is somebody that just did it right. They didn't panic. They stayed invested. They held the course. They had a plan, and they got 9%. Just 10 days of missing of the 10 best days in the market would have dropped it up, more than 50%. So when it comes to investments, especially your retirement account. Now, let me pause it. If you've got some side money and you're going to dabble in cryptocurrencies and all the fun buzzwords of the day, I'm not talking about that. That's on you. Work with an expert or do it yourself. But when you're thinking about your retirement money, it's money that you need to have properly invested and plan on leaving it invested for as long as you're going to be participating, and hopefully all the way through retirement, because this is what's going to get you to the retirement that you want to have down the road. Now, with that, there's volatility. There's been more lately than ever before. I doubt that's going to go away. Maybe we're in a little bit of a period of time now where it's a little bit more stable. But there's all sorts of different risks that factor into investments. There's business risk. Are we going to invest in a company? Are they not going to be around in 10 years? Is one of these pharmaceutical companies going to come out with we'll just use the vaccine for example. All of a sudden it turns into a disaster. Theirs doesn't work, and they're out of business. They're not Pfizer or Moderna or, whoever, Johnson & Johnson. There's general market risk, just what's going on in the market. Inflation's a big one. I see a lot of people invested in their retirement plans that are way too conservative for the amount of time they have left. And we all know there's inflation. It seems to be picking up steam a little bit now. It's been a little bit lower than normal lately, but that's just simply how much is it going to cost to buy something in 5 years versus what it costs today. We all know prices are get more expensive over time, and you need your investments to keep up with that at a minimum. There's interest rates, and then there's international stuff as well. So there's a whole different types of risk, and this kind of sums up what I said about volatile markets. Don't make emotional, rash, spur of the moment decisions. Take a pause. It's a great time to review your balance. Probably going to shed a few tears if it's a bad time and you see how much you've lost, but that's not the time to panic. But were you properly allocated? Were you well diversified? Is the fund you're in performing the way that they say they should and the way you think they should? If it's not, maybe it's time to have a conversation with someone about doing something a little bit different. When the market went down, I had people call and say, hey, what should I do? I told them to add more risk. The market had just dropped a lot. It was bound to recover. So now that was a great time to be a little bit more riskier because you had some good upside when things started coming around. These last things really come down to having a plan. I tell people not having a retirement plan is not a good plan to have because you've got to go into it hoping everything's going to work out, and hope usually doesn't work out the way you want it to. So the sooner you can kind of start piecing together what you want retirement to look like, How much money are you going to need per month? You know, how much of your pension is that going to cover? How much additional do you want to have between your retirement savings? If you're married, your spouse's, is there Social Security? You know, start trying to get a picture of what that is going to look like holistically, because it'll help you know, hey, we better get a little bit more aggressive in my retirement plan. You know, I'm saving 6%, but if I bump that up to 8, look at the difference that's going to make in 10 years. Things like that. And so, and it also helps you know, when's the right time to retire. You know, as those of you in education, you know, you've got the huge advantage of a lot of you are able to retire early. You get to your 30 years in your early 50s a lot of times, right? That's great. But the flip side of that is you got to plan for a significant period of time in retirement. Now, granted, you got your pension, which is awesome, and that's going to cover a good portion of it. But you want the other stuff you have to last a long time. So, you know, as you think about your investments as a whole, and I try to help people with this too. It's not just about one account. It's about everything that you have. It's about your account, your spouse's account if you're married, anything additional. Does it as a whole cover you, you know, have you properly allocated the way you want to be based on your goals, your risk tolerance? And we're going to talk a little bit more about that. But you want a good mix of all sorts of different things. You don't want to be 100% conservative in a fixed income account because you can't make any money, nor do you want to be 100% in international, because that's so hard to, you know, understand what's going to happen. Even for the professionals here that, you know, that do this for a living every day, they get it wrong all the time. So you want a good mix of different asset classes, and we'll talk a little bit more about that in just a second. So this is just what I was saying. You know, keep it diversified. It'll help you get your goals, and over time, being asset allocated has almost always been a wise decision to make. So just a couple of the basics on things. You know, mutual funds are the way most retirement plans are invested in. That you've got mutual options within your Lincoln plan as far as different funds. They all have different objectives. So, you know, if you want to be somebody that kind of picks different funds based on, hey, this is a small cap fund, or this is an international fund, or this is, you know, fixed in a bond fund, you know, just understand what it is, understand the risk associated with the different mutual funds. But once you do that, you don't have to worry about anything else. They're professionally managed. They're making changes based on the world we live in and what's going on at current times. And those are phenomenal options to do inside of your retirement plan. For those of you that are very much set it and forget it, you just want to do something and you don't want to think about it for the next 10 years other than how much am I putting in, target date funds are a great option. Those are a mix of multiple different mutual funds that it's professionally managed as a whole. And what the target date does is it assigns you a target date fund based on when it assumes you're going to retire. So if you're 40 years old, they'll probably put you in like a 2040 target date fund, saying this person will probably work another 20 years. They're going to retire at 2040. So you're in the target date 2040. What those funds do is as you get closer to that retirement date, they automatically get a little less risky every year. They pare down the equities every year as you get closer to retirement, up the fixed income a little bit, so you know it's being adjusted appropriately. So those are great options for someone that just says, you know what, I need to be in the market. I'm not exactly sure, you know, what that looks like for me. Go into a target date fund based on the year or somewhere around the year you're going to retire, and you don't have to worry about it again. It's a one-click option to kind of take care of all that. Because here's kind of how risk works when it comes to investing. You know, this is the different levels. Most conservative on the bottom, riskiest on the top. So, you know, you think treasury bills, those are as safe as it can get. Then you get into some government and corporate bonds. Balanced funds, those are, you usually have a balanced fund option in your retirement plan as well if you just want a fund that's the balance of all this stuff. Then you get into the large U.S. stocks, you know, the Coca-Colas and the GEs, and you've probably heard of Walmart, things like that. Then you get to mid cap, small cap, international. You know, every time you go up a level, it gets a little riskier. But with taking on more risk, you give yourself more opportunity for upside as well. So it's kind of a balancing act, which is why those balanced funds do well. But you got to take some risk. You just don't want to take more than is comfortable to you. which leads me to this, and I'm going to send this to Janet after our call. This is just a little worksheet that you can answer a handful of questions. It'll give you a score at the end, and it'll help you get a basic idea of how much risk you're comfortable with. If you go through this and don't know how to answer the questions, reach out to me. I can guide you through it a little bit. But what does happen sometimes is, more often than not, someone says, "Oh, I'm great with risk. I don't mind it. It doesn't bother me at all," until they ask some of these questions about, how would you feel if, and they're like, "Oh, I would feel terrible. I would be upset if everything went down 20%. Well, you're probably not as comfortable with risk as you thought you were. Or maybe you come to the end and you're like, "Hey, the scoring system at the top is 5 to 7 is conservative." If I'm sitting down with somebody that's in their 20s or 30s or even 40s, and they're telling me they're a 5, 6, or 7 on this, I'm going to tell them they might want to reconsider and probably, become a little bit more used to taking risk, because, you can afford to take a whole lot more risk the longer you have to continue to stay invested. So the hard thing to do is to know exactly how much you're going to need. I literally had a call before this, and the person was like, "Will you just tell me how much I need to save?" I'm like, "Well, I can't just give you a number, because it depends on what your goals are and what do you want retirement to look like? Are you going to need, 50,000 a year, or are you going to need 100,000 a year?" I mean, there's lots of different variables. Most people need between, around 75%, to 100%. That's probably a little aggressive, of their pre-retirement income to maintain the same standard of living. Hopefully as you get toward retirement, your debt situation is gotten better. Maybe you paid off your house, so you're no longer paying a mortgage. You don't have car payments. So you don't need quite as much to kind of maintain the same standard of living. Y'all have a great advantage with the pension of knowing you're going to have, somewhere between 40 and 60% of that automatically covered. But I don't know too many people that want to live on 40 to 60% of their income. You may be able to, and some people can. That's great. Most people, as they think toward retirement, they've got a little bit different goals and objectives and want it to look a little bit different. So your retirement plan, anything else that you can save, that's what's going to fill the gap between your guaranteed money and the additional amount you're going to need on a monthly or annual basis to do, to live the life that you want to live when it comes to retirement. And we talked about this too. You're going to need that money for quite some time, right? I mean, if you retire at 60, people are average age now is almost, 86. Couples, the likelihood of a couple living, one of the persons living to 90 is up at, 60, 70% now. So you got to plan on this life. This isn't like, "Hey, I'm going to retire and, I need 10 good years and I'm out." Hopefully that's not what happens. So you got to have some realistic expectations about living long, and certainly make the plan. But again, with your pensions, that's guaranteed for life, so which is a huge advantage that you have when thinking about lifetime income. And for a lot of people, the first 20 years, the money may look a whole lot different than the next 20 years, right? You're healthier, you're younger, you're traveling, you're playing, you're doing stuff. A little later, you may not need quite as much as you needed up front. So, but we already talked about this. Inflation is going to be there. It's never going away. We know things are going to cost more. So you have to account for that as you think about how much you're going to need long term, which is why, when I see people that have a big portion of their investments in fixed income or money markets or, stable values, there is a place for that type of investment. As you're in retirement and have some needs in the next few years, there is a need for very, very, very safe, conservative, can't lose any money investments. They don't typically do well when you think of 5, 10, 15-year, time frames, because they just can't keep up with inflation right now because of where interest rates are, right? Interest rates are next to zero. That's not going to change anytime soon. So we all know, if you got a checking account, you see 2 or 3 cents being added to your account, every month, because that's all they're paying, and there's just no way to get good returns on guaranteed money right now. So please be careful about putting too much of your retirement money in the stuff that can't grow or isn't, is growing at 1 or 2%. And then this is just a fun little formula, the rule of 72. This kind of just, hey, if you've got X amount of money, how long is it going to take for that money to double if you're getting X rates of return? So if you got If you're getting 6%, it takes 12 years for an investment to double. 8 only takes 9. 12, 6. So that's just people kind of, a lot of times people want to know, hey, I've got $100,000 in my retirement account. I'm going to work for 10 more years. What's that going to do? Well, if you don't put anything else into it, you're probably going to have twice that much in 10 years. Plus, hopefully, you're continuing to add additional amounts every month, so it looks like that. So the point of diversification and being spread out is to balance your risk, not have too much risk in any one category. So if something happens in that one area, it's not devastating. It's just a piece of the puzzle. Different asset classes allow you to do that. I encourage you to kind of, at least on an annual basis, review and kind of make sure you understand this isn't something that most people want to look at every day. I wouldn't even encourage that, even on a monthly basis. This is long-term retirement money, but having a general understanding of where you are, what you're invested in, and why, right? Just makes you a smarter investor and will make a difference when it comes to retirement long-term, because it'll help you reach the goals that you are trying to get to. And like I said already, if you have questions about that or don't understand it, please don't hesitate to reach out to us. We're here to help, to guide you in any way. People, there's different types of investors. Most people in retirement plans are kind of the do it for me. I just want to put in like a target date fund or the do it myself target date fund and leave it. If you want to be a little bit more aggressive and a little bit more hands-on, that's fine. Just make sure you understand what you're doing. Don't go into it blind saying, the worst thing you can do is look at your list of options in your retirement plan, find the one that did the best last year and put all your money in that, because those almost always never do the best multiple years in a row. It's all about being spread out, diversified, managing that risk, depending on how involved all you want to be. So we're going to wrap this up here just in the next few minutes, and I'm going to open up for questions for anybody. But, just remember, the market's always going to be volatile. That's not going away, right? Every time there's been a bear market, on average, the market's done extremely well the following, several years, and sometimes even 5, 10 plus years. It's human nature to get concerned and anxious and worried, but you got to avoid making emotional decisions based on one day or 1 week or even 1 month of circumstances. It's a long-term, it's a marathon, not a sprint when it comes to investing. So, ask for assistance, be well allocated. Don't have everything in one type of investment. Use multiple investments that have different types of risks, different type of investments, and help. And we're here to help you do that. So that we already kind of covered that. So I'm going to open it up for questions. But again, like I said at the beginning, we Arista, we want to make sure you've got best-in-class retirement plans. I, with my team, want to make sure you got someone to reach out to, shoot me an email, give me a phone call, set up a meeting, whatever you want. And again, this from a Arista standpoint, this isn't just about your retirement account. Lincoln manages that. We help kind of oversee that. But if you want kind of a big picture puzzle, a financial plan, make sure you're on the right, make sure if you think you know where you're going, let's make sure that you're, actually headed where you think you are. But we want to be a resource just to give you somebody in a safe place to, I'll spend as much time with the 25-year-old who can't figure out that they can't spend more than they make as I will with the person that's, 2 years from retiring. So, there's no dumb questions here. If you want to know what retirement's going to look, if you're in that period of time, 1 to 5 years from retirement, and you want to make sure you're kind of on track and kind of see what that looks like, I'm happy to put a plan together and guide you through what that would look like. But, we just want to be a good place to help give you a place to ask whatever questions you want. Our mission at Arista is to lead people to financial security, and we do that by helping with these plans, make sure the plans are best they can be, and then helping with any individual that needs some guidance to take the next step toward hitting their goals and objectives. So anybody have any questions for me? And like I said, if you're not comfortable asking it on a big group, I get it. I'll have Janet will have the way to get a hold of me afterwards. It's extremely easy. Just click on my calendar, schedule a meeting at whatever time's convenient for you.
Hey, Toby, I think if anybody out there doesn't feel comfortable or doesn't have a microphone, you can, at the bottom of your screen, if you hover over chat, select that, and you can type a message to everyone in the chat, and I can read your question for you too.
Yep.
So we have one question out there already, Toby. Tell us the
Okay.
difference between a 403B plan and a 457 plan.
Okay, so they're both government-sponsored plans. They're both available to you. Most people do the 403B. There are a couple of key differences. If you're putting money in a 457, the biggest advantage is you can pull money out of that earlier than you can of a 403B. So if you retire at 55, you can take money out of a 457 right away without penalty. If you're in the 403B, you have to wait till you're 59 and a half in order to have access to that money without penalty. Now, with that, you have a whole lot less flexibility in a 457 plan. They're not transferable. So if you go teach somewhere different, you can't, it's still your money, but it stays where it is. It's not like you can roll it into a new plan like you can 403B. So, you know, if you've got some time to retirement, it's never a bad idea to do a little bit of both, split it up. That's not a, you know, because that just gives you more options. If you said, I'm only going to do one, I would probably tell you to stick with the 403B. You just have more, it just keeps you more flexible, more options. But with that, you know, if you're going to retire at 55, you do have to plan, you know, what does that look like from 55 to 59 and a half when I have full access to my 403B investments. You always have access to it. It's your money. No one can take it and no one can say no. But if you take money out of a 403B or a 401k, if you got a spouse in corporate world, prior to 59 and a half, you pay taxes and a 10% penalty.
Hey, so Toby, my question, so you say you pay taxes, and I know my microphone's not working well.
Okay, I got you.
You say you pay taxes and a penalty. What are the taxes after your retirement age?
It's whatever your individual income tax rate is.
Okay.
So in theory, right, you're not paying taxes now on the money that you're putting in your 403B. You will pay when you take out. Hopefully you'll be in a lower tax bracket because you're no longer working. So you're going to pay less in taxes then as you would now. Now, you're assuming where taxes are going to be in the period of time, which nobody has any idea, but you know, you pay ordinary income tax on the money when you pull it out at retirement.
Okay. And then my next question is, with Arkansas Teacher Retirement, we have what's called T-Drop. Are you familiar with that?
I am not. I can get familiar with it, but I'm not right now. But explain it to me. It may be similar to some of the others. I say that because I don't know if Arkansas is different than Georgia or, you know, some of the others we work with.
Okay. And so basically, after so many years, you can opt to take a portion of your retirement and put it in an account.
Mm-hmm.
So I have money in a T-Drop account that's just sitting out there drawing interest and all of this. When you pull money out of that, it seems to me like it's going to be the same. I'm going to have to pay taxes. I'm going to have to pay income tax on that, correct?
Correct.
Okay.
Janet, unless you know something that I don't about that, I'm pretty sure that's a yes.
Okay, Toby, we've got another one in our chat. And I don't know if you'll know this one without looking at our plan document. What is the management fee percentage on our 403B?
I will have to look in the plan document to get that.
And so I can answer that a little bit. It depends. It isn't the same percentage for everyone. We used to be the same percentage for everyone, but we have moved to a blended fee structure where we have both, everyone pays a flat amount just to have an account, and then the percent, and then you pay an additional percent depending on your account balance. And the reason we did that is because in the old way, it takes them the same amount of time to manage an account, whether you have $10 or whether you have 10,000. So what would happen is that person with 10,000 would pay a whole lot more fees than the person with the $10. So I'm pulling up our plan. If I can get an answer before we end the call, I'll be happy to share it.
Thanks, Janet. Anyone else? Janet, we're good? All right, well, let me just close by saying thanks for hopping on this. I know it's after the day and this was, but hopefully you found this educational. Hopefully you found it helpful. Hopefully it gave you one or two things to consider as it relates to your retirement, your finances, whatever it is. But kind of back to where I started, I just encourage everybody to have a plan. Don't be afraid to ask questions. Make sure you're allocated according to where you should be based on your risk tolerance and age and time left till you retire. We'll send out a form to kind of help you gauge that as a follow-up to this call. But schedule some time if you want to have a discussion. Everything's always completely confidential. And if you want your spouse on the call, that's fine. Whatever works best for you, your family, your situation. We just want to be a resource and help you kind of get that next step toward financial security. So with that, I'm going to stop sharing and stop recording and wish everybody a great Wednesday evening.
Thank you so much, Toby. To all my friends out there, all 26 of you, our hope is to offer this as a series, that this will be the first of many. So if that is something that you'd be interested in, if we continue to offer these, shoot me an email and say yes, or shoot me an email and say, thanks, but that's really not helpful. This is really more of a conversation we need to have one-on-one. Let me know that too. So any feedback you have would be great. Toby, thank you so much.
Even a specific topic, if you say, hey, I would love for Toby to talk about XYZ. I mean, we can make those suggestions, and if it's something that makes sense for everybody, I'm happy to do whatever makes most sense for everybody.
That's great. Thank you.
Thanks, everyone.
I'll send out an email with information. Thanks, Toby. Bye-bye.
Thank y'all.